So that's pretty significant. So what that means is that we have phenomenal growth forecast for 2021. If in fact that corporate tax rate goes from 21 to 28%, every company inside the S&P 500 can expect a $15 to $20 decline in their operating earnings. Massive numbers that come into there. As you talk about individual tax rates and the inheritance tax and the step-up provision, what that means is that it causes a drag on your disposable income. How much money do you have to go out and buy those, I don't want to call them luxury items, right? But think about it. If I want to take that vacation, if I want to get the girls new clothes, all of that's my ordinary income that gets eaten away because I need to pay it for taxes. Mm-hmm. The increase in the implementation of financial transactions, we think becomes monumental. Because especially in a market that is as fluid acting as it is today, and one thing I do encourage all of our participants today, do not take a look at the markets every day. Turn off CNBC. Right. I do myself. But that's an additional cost that actually comes into there, which is very important. And then even the bigger one is going to be the treatment of tax distributions on your 401k and your individual IRA programs. Mm-hmm. All of that becomes left up in the air. And what we're going to see over the next month, we believe is going to be more and more, the rhetoric's only going to grow louder, unfortunately, right? So what that tells you is what's the infection trend, the fatality rates. Is there a vaccine out there? How loud will the ongoing protest and the social unrest transpire? And at what volume will it take place? We have the debates that begin on September 29th, next Tuesday, which is going to be a very big one, right. As well as the uncertainty with mail-in voting that transpires out there. So as we
may I jump in for a second? We did have a question that came through, and why don't we answer it since we're right on the topic of a particular election. Would it be safe to assume that the upcoming election regarding the Senate race is more important than the presidential race? Great question.
I think that's a great question, and thank you so much for asking. That becomes a very important point, especially since we now have an open vacancy on the Supreme Court. So right. I can't say one's going to be more important than the other because the system of checks and balances that we have in place, but the Senate is very key because if you get a Democratic sweep, the markets tell us that you can anticipate 3.9% sell-off in the S&P 500 that first month. And I need to take a look at my notebook for that number, but I just looked.
No, I understand, and it's fine. I understand what you're talking about, having Democratic Senate, having Democratic House, and potentially having Republican office. Those combinations are very important in the short term, right? I mean, that's why the market's doing what it's doing. Markets don't like uncertainty.
And that leads me to where we are today. And hopefully this doesn't get too technical as we talk about it, but I'd imagine people have questions about why we're seeing the volatility from the 11th of September to where we are today. And what does it mean for your overall portfolio? So in the short term, what it means is that we have three specific events financially that we're watching. One is the hard Brexit, which is very important. Number two would be a contested election. And then number three is resurgence in COVID, not only domestically, but also globally, as we have children going back to school. So what that means is that we just put out estimates on Monday morning. I spoke with my rate strategist. Now I love this individual because he doesn't manage money. He forecasts interest rates movements for the general account. So we're an insurance company. So we really want to follow interest rate movement. So what we believe that's going to happen over the next few weeks is that you're going to get a rally in treasuries because of the three events that I just spoke about. And we believe that you're going to find support levels at about 58 basis points. So what that means to everyone on the call here is that the 10-year Treasury on Friday was at 70 basis points. When I get a rally in Treasury, that means that my yields go down. And my yields will go down to about, call it 55 basis points is where we see that support level. So after all this gets figured out, and we believe it will be figured out before year end, what you'll see is a sell-off in treasuries, which means it'll peak out at about 85 basis points on the 10-year. So that choppiness is going to transpire because, to your point, the market does not like uncertainty. It's seeking safety, stability, and security right now.
Right. And I'll just jump in very quickly, ladies and gentlemen, to share with you that a basis point is 1/100th of a percent. So 55 basis points is basically 0.55 of 1%. So consequently, 85 basis points is 0.85 of 1%. I mean, it's shocking that we're discussing interest rates that are so low that somebody told me the other day, if I open a bank CD, what will I get? And I told them, oh, a very firm handshake from your banker.
I think it makes, thank you so much. Sometimes, pardon me, I do industry jargon.
Right. We do have our own language. You're absolutely correct. We do.
Sorry about that. So as I look at it as an investor, what's the biggest challenge that I have? And it's to your point, you're going to get a handshake when you go down to the bank because
big thank you.
Interest rates are so low.
Right.
So the way that I take a look at it is that all I want to do is follow that 2-year treasury. So the 2-year treasury yields in interest, call it 15 basis points, or to say it, if $1, this pays 15 cents, right?
Yeah, exactly.
So just think to yourself, how do I beat the 15 cents?
Yeah.
And that'll tell you, do I want to pay off my auto loan? Do I want to pay off my house? Well, if I can find an investment strategy, an investment policy statement that's going to allow me to beat that, then that becomes your answer.
Right.
Purely on a mathematical level without taking any emotion into it.
Excellent. Good job.
So thank you. I greatly appreciate it. Thank you. It's going to be a very fun election. I was very surprised that our rate strategist came out, and money managers and strategists do not talk about politics.
No.
They're simply there to manage money in the forecast interest rate movement.
Right.
So when he came out and shared with me that he believes that it's going to be a contested election, that means that he is managing hundreds of billions of dollars in the event that that will transpire. So I have a lot of conviction in that belief right there.
I mean, without a doubt, it's going to be pretty chaotic, no matter how you slice it or dice it. In 6 months, it's going to be irrelevant. In 9 months and a year.
Yes.
I mean, any presidential race you take a look at historically, if your question is, should I, and I get this like daily, right? We're also into our season when we do our semi-annual reviews with our clients. Look, we were well prepared to go into the pandemic, not because we knew it was going to happen, because the market was at its all-time high. We took 20% profit across the board, moved the money into money markets just to wait for the market to die down a little bit. We did not foresee such an incredible sell-off, but we were able to invest half of our cash position into the sell-off at 40% discount. All of that came back. We still have cash on the sideline, and we just beefed up our cash position again, meaning that the following. When I was asked, should I sell everything and just wait to see what happens and then invest money at the end of November? And I said, no, because of market timing. And time again, it shows that market timing does not work. You should be in the market. You need to have a plan, which is what we have in place, to have some money on the sideline. If the market sells off, which is what's happening right now, and actually market, and the reason people looking up is because I have TV in the office up there, the market is negative for the year again. So if you invest the money in January through now, you're flat, even with a 40% dip and whatever happened afterwards. You need to have the money on the sideline. You need to have a plan. Are we deploying the capital if the market sells off? That's the plan. But if the market goes up, then you know what? We had some money in short-term money markets, short-term investment instruments that were still working for our clients.
Yes.
Well, I think a lot better than 15 cents on a dollar.
Yes.
You know?
And to your point, I think another big thing to keep in mind is that the Fed, who sets policy, monetary policy for the country, they've deployed 13 different programs and in excess of $4 trillion, that's with a T, $4 trillion to present calm to the markets. So anytime you have $4 trillion back behind you, it reminds me of 2008, 2009 scenario in which the verbiage is don't fight the Fed.
That's right.
And now what we're doing is just follow the Fed, right? Follow where the Fed is buying investment securities, and that becomes a good plan as well.
Right. No, I completely.
We are very constructive on the overall market. But coming back to the political point of it, as you take a look at some of the programs that the Democrats would put in place, that is something that you definitely want to have a conversation about. And I'm sure, I know you guys are already having it.
We are, and we definitely have, we had a plan in place in August, right? When the market yet again came back after such a big dip that took place in March, April, May, when it rallied back up, we said, too fast, too soon, but in reality, it reflected where the economy should have been if we didn't have the pandemic.
Yes.
So kind of, you draw a line, and that's the support level, which is why the market's bouncing. It was down a lot yesterday. There's another big factor, and we discuss it a lot with our clients. Valuations. I use this very simple analogy. If I have a cup of coffee or a glass, or let's use a cup of coffee. Would you pay $1 for it? Probably, because that's what it's worth, right? $2? Sure. $3? Yeah, fine. $5? All right, maybe on the steeper side, but that's what Starbucks charges. Yeah, but would you pay $365 for a cup of coffee that's worth $1? Probably not. Then why are you buying Netflix?
Exactly. It becomes that easy. And that $5 that you spoke about is your disposable income.
Right. Exactly.
In the event you do go from 37 to 39.6. Now, let's be candid. If you're in the top tax bracket, you're not worried about spending $5 for a cup of coffee. But as we take a look at the median of America, that's real.
Right.
That's significant to them.
Right. And I will look it up. This is a side note, and I'll find it. I'll send it to you. I remember, gosh, this is going back to my economics days when I was in school. And an economics professor, I studied in China, and I remember it was an American professor in Shanghai who was teaching us. And he was explaining what does the GDP growth mean, right? Like physically to an average American, let's say 2%, 3%, 5%, 7%. Nobody really understands it. And I remember he was explaining using a really vivid analogy, but that was the first and the last time I heard it, where, let's just say if GDP growth is 1%, right? The children are not having ice cream, right? The parents don't have the money to support them to have ice cream, right? If the GDP is half of 1%, then the family is not eating because there's no money. Well, you're not going to eat, but that cuts into the things that you can do. Now, GDP, let's say, is now 2%. Well, are you not only eating ice cream, but you're getting new pairs of rollerblades? Right? So it literally is like that. Now you put politics on top of it, and if the economy is growing at 2%, and let's just say it's a comfortable position, right? Trump was saying 3% every year, because at 3%, that means everyone's having ice cream, everyone has new rollerblades, new cars, vacations, which is what is the most important thing at the end of the day. Who will help to make sure that I will put more money in my pocket, more than I did last year, take a vacation with my family, right?
Mm-hmm.
And, lost my train of thought, but that happens when we digress with our personalities.
But to your point, that's when we talk about the $15 to $20 on every company in the
Taxes. Yes.
500. If these programs are enacted, that means that it's going to be very challenging.
So,
one for the market.
That's my train of thought. Thank you for indicating it. When we discuss this and people go, well, you know, pay your fair share, put more money into the taxes. It's like, okay, well, then I will take away that ice cream at 2% growth in GDP. I will take away that ice cream from my children. And this is just metaphorical, right? Ice cream. I take it away from them, and now I don't give that ice cream to somebody else. I give that money to my government, and then they decide who gets not that ice cream, but who gets to drive a new car, spend money on infrastructure, ship money overseas because another country needs more money. And this is where, well, I'm working, and the money that's being taken away from me now proportionally is higher. So the things that I can afford, like put money towards college for my children so that they don't take out crazy loans, you know, support my local charity, those opportunities and options are now being taken away from them. That's it.
That's exactly what it means.
And this is where I feel that the discussion the economists have, obviously, is much more detailed and deeper than what the politicians talk about. Let's do this, let's do that. But again, at the end of the day, this is why we manage our clients' relationships. We help them with their budgeting, we help with the financial goals, and we make sure that at the end of the day, there is no life left at the end of money. Or like I used to joke, you know, there is no month left at the end of money, because that's it. Right?
I think it makes a ton of sense.
Thank you, Tim. Anything else? What are you guys doing at Transamerica right now? And you alluded to the PMs, the portfolio managers, and the strategists. Are you guys well prepared to navigate through this, or are you now looking already towards the end of the year or next year, kind of running out several scenarios?
So the word that comes to mind, are we all in Jersey on this call, or the tri-state area?
Creighton is licensed in 25 states. So we're from here to California, from Maine to Florida.
Okay. So I would say only because it's my only experience here is in the tri-state area. We've been under lockdown for about 6 months now.
Right.
So what it means in our house is that we're eating more cereal than ever. We're having more healthy snacks than ever. And we're drinking more beer than ever. I'm not the only one. My neighbors are the same exact way.
Right.
But what that means is that companies such as General Mills and Post, who make cereal, nutrition bars, companies such as Anheuser-Busch, who creates alcohol.
Yep.
Even though consumption is at its all-time high, you still see those companies trading at about 15 to 20% off. Right. Campbell Soup, Kraft Heinz would be another example. So what we're seeing is that there's no price discovery out there. So we can talk about valuations until we're blue in the face, but no one cares. Until we get that price discovery in the markets, that's what we're waiting for. Because if I was invested inside of large cap growth, I'm glad we both know this, or I was invested in the large cap value, there's about a 50% dispersion between those two asset classes.
Right.
So it's the technology companies, which valuations really don't matter, right? They've just blown the doors off. And for that, you want to follow the NASDAQ, which is, I mean, generally they show you the Dow, the S&P 500, and then the NASDAQ.
Right.
Your NASDAQ is going to be your tech sectors that you're going to follow. So that's your Apple, your Facebook, your Netflix, so on down the line. That's really what's driven the market so far. Right. We do believe that we will get price discovery, especially as we talk about rebounding up 2021 forecasting 26% increase in earnings per share. That's massive numbers. Right. So the way that I want to take a look at it, and I was laughing because I was in a class on Monday night,
Okay.
and a woman gave a review on Campbell Soup, and there were only 18 people in this class. 17, and the last question, would you buy the company?
Right.
And 16 people said no, and 2 of us said yes. And so the professor asked, why would you buy it? And I said, why would I buy a company that's already up 1,000 points, hello Tesla, when I can buy a company that's off 20 to 25 points in the year? I like discounts. I don't want to spend extra money for that cup of coffee or for that car or, in this scenario, for the soup. So when I find things that are red, simply meaning that they've met headwind, they've sold off for a particular reason, that's where I want to go to.
We've discussed, and this again, look, my entire education is in econ and finance. My MBA is in the same field. I've been at this for 20 years, right? 15 years in a professional capacity. So kind of, it's not like I'm going to stop doing this and tomorrow I'll start a landscaping company. But that discrepancy, like Ford, American automaker, right? Less than $7. And they're the largest manufacturer of automobiles in the world. And they're trading at like slim to none their future earnings. Tesla, that manufactures 50 vehicles and 25 batteries, is trading at thousands of turnover ratios and any kind of statistics you utilize. So there comes a point where, well, NASDAQ, is leading the sell-off right now, just like NASDAQ was leading the growth. But you're right, Campbell, Ford, General Motors, these are the companies that are not sexy. They don't have any cool stories behind them, but they're the ones who make the world go round. They're the ones who are consistently there. Coca-Cola pays 3.5% dividend. And Coca-Cola is consistently there. AT&T, Verizon, they don't jump up 20% or drop down by 20%, but both of them, AT&T's yield right now is 7%,
which is fantastic. So go back to one of the questions that we talked about when we were talking about how can I beat the 2-year Treasury?
Right.
So if one yields 0.15 and
right.
Coca-Cola, or I'm sorry, AT&T 7, Campbell 3.4. The asset class is 3.2 is what I see in my head.
Right.
So I'm being forced to go into the equity market at a discount because I get a better income stream off of it.
And this is why ultimately, regardless of what's going to happen with the election, the market's going to be propped up. The opportunities are going to be there. There's also terminology, and this is not for you, Tim. This is for everyone who is listening. There's a terminology called sector rotation, which there are only 10 sectors, right? So like all your gas and oil companies are part of the oil sector. Then all your real estate is part of the real estate sector and alike. And it's only natural from time to time money to leave one sector to go to the other and just kind of rotate. That's what we call it, the sector rotation. It doesn't take a real big genius to realize that it's not sustainable to sell, Apples and Tesla and everything else and Microsoft's at these exuberant levels where you have these quality companies, like we said, Campbell Soup, right? Ford, General Motors, and many, many more. And then, forgive me, this is not a testament to these companies. I'm just drawing a parallel to show you that it's only a matter of time before money managers and portfolio managers, and not your, pajama warriors who trade on E-Trade and, these little dinky accounts and buy a $5,000 position in Apple, which corresponds to slim to none, versus somebody who comes in with $500 million and buys a position. This is why ultimately the ups and the downs, this is exactly what you said, Tim. The daily fluctuations are completely irrelevant. Even quarterly are not enough. And look what happened, 6 months, right? We went down 40%, up 50%, now down 10%.
Yep.
And this is all in the span of 6 months. So it takes 3 to 5 years just to identify if you're in the right position, which is why diversifying the portfolio and not just tracking indexes truly becomes a much more prudent approach to investing money. This is great, Tim. This is a wonderful conversation. You know,
Very well said by you too.
hopefully providing to our listeners is tremendous. And Tim, anything else that you'd like to add?
I think, one, this has been a lot of fun, so thank you. As you take a look at a step ladder, my step ladder is not going to go straight up. I have rungs all the way through.
Okay.
So when I do take out those daily up and downs, and to your point, the names we mentioned are not sexy names. You're not going to go to the next picnic and say, oh, by the way, I bought that.
I loaded up with Campbell's soup.
Right? You got to come to my storage shed and see how much I have.
Right.
But that's investing versus speculation.
Right.
Very big difference that sits inside of there. Yeah. So I love that point.
No, I agree with you. And it's, look, you know, people go and gamble, they enjoy it for fun. There are people who develop problems and it becomes a problem, right? When you have a brother-in-law syndrome, which is, you know, my favorite analogy, you know, your brother-in-law always tells you how much money he earns or how much money he wins or how much this project yielded. But he never tells you how many times things have not worked out, right? So when you hear about people like, oh, I bought Tesla 200 and I wrote it 2000, first of all, I've never seen anyone, and I've been many, many years, who is like, you know what, I got an inheritance and it's 300,000 and I'm buying Tesla. Or when people talk about, I wish I invested money into Google. Google came out at $75. I was literally in college when that happened. And they were doing subscription-based model. No one has a crystal ball. The hindsight is 2020, right? The future vision is not. So again, the pajama traders, I would call them, you have all day, you're locked up, nothing's going on. If this is your hobby, so be it, you know, but don't treat it any more than you would going to Atlantic City or going to a casino. And this is not the money that you pay mortgage with. This is not the money you pay for college tuition with or plan to retire on. You know, if you're up 60% in company, you know, don't confuse, you know, your brains for a bull market.
Mm-hmm.
You know, so excellent.
Well, thank you. It's been a lot of fun.
Absolutely. Great. Always a pleasure. Always a pleasure. I love our dynamic, and I can't wait to see you when hopefully things, you know, clean up a little bit and clear out. But ladies and gentlemen, if you have any questions, or you'd like any commentary, please feel free to reach out to our office. As you can see, the things that we discuss, you know, they're down to earth. You know, we will provide, we will continue to provide you with guidance and provide you with information that will help you to achieve your financial goals, which at the end of the day is the most and the only thing that matters. Whether it's the Republicans or the Democrats, liberals or conservatives, at the end of the day, we're here to make sure that your money works for you as hard as it can and make sure that all your goals and objectives are being met.